Guys, welcome to Season 5, Episode 2. So today I'm with Chirag, one of my really good friends who I've roped in to ask me a few questions in this session, and he's laughing because he's going to absolutely make me look like an idiot with
I'm
his
laughing
questions.
because I'm going to ask for discount on the next. You put me to work here.
Yeah, exactly. So I'm roping some free labor. And then the next session after that will be Episode 3, where Chirag will also share his walkthrough working with Quiddity Wealth, talking about the deal that we are going to be presenting in this podcast, but also the whys and the hows and why do you think you are investing through us. So let's get going with episode 2, which is all about the questions we've got from social media, and we've condensed it into a quick fire round that Chirag's going to put me through my paces. How are you feeling about that?
I feel pretty good. How are you feeling?
I'm a bit scared, actually.
It was a little high pressure situation. I got all the dirt.
Well, I also got you to run from Liverpool Street to get here on time. So, so thank you for that.
I know. I was halfway through this run thinking, did I pack my inhaler? Trousers falling off. Me trying to get him. Like, what? This guy's gonna kill me.
So let's hope you don't need you don't end up needing a puff. Okay, so let's get going.
Is it?
Yeah. Well, not that kind of puff. You know, the inhaler puff. So,
all right.
What have you got for me?
All right, some quick fire questions, format that I think all the audience are used to hear. Quick question, and this is just to level set everybody here.
Yep.
What is title splitting in one sentence?
You break something up that is originally as one unit, but you're breaking it up into several units. That's not one sentence, but ultimately you're breaking something up. So I describe it, funny enough, it's like going to Costco. You buy the pack of toilet tissues in an 8-pack for £8, let's say. So a pack is costing you £1 on entry on the kind of the wholesale. Then you bring that pack of 8 toilet tissues back to your retail shop and you sell it for £2. That's what title split, what we're doing. We're breaking up the wholesale pack into a retail unit, and that's how we refinance it out. We increase the value out of it.
Yeah, it's nice. It makes sense. I think, consistent with renovations, fittings, bathrooms, and now stocking the bathroom as well with toilet rolls.
With the toilet, yeah, exactly. Toilet tissues.
All right, let's go. We only got 8 minutes.
Yes.
Why is it outperforming buy-to-let right now?
To be honest, it's been outperforming buy-to-let for a while now. I mean, actually, we were competing with HMOs for the last 10 years, but nowadays, it's a no-brainer. If you've got a buy-to-let, on average, if somebody who's an investor now and buying, you will know that you're making about £200 to £300 per house that you've bought as a buy-to-let. If you're doing a HMO, as you know, we've been selling HMO or repurposing our HMOs now into single dwelling because the HMOs just don't work. The cost of mortgages have doubled. Utilities have trebled. Well, right now with Iran war, it's probably going to quadruple. So the utility cost has gone up. Then you've got all of the other costs of maintenance, management. So HMOs don't work. Why does title split actually outperform? Really for 2 reasons. One, you can recycle most of your money back out of the ones that you've bought to reuse the same money to buy the next block, so you can scale up a lot quicker. And the second reason is because you're buying multiple units at a time. So instead of getting one £300 on one buy-to-let house, you're getting 8 times £300 on a block of 8 flats, for example. And that's why, for me, it's investment on steroids right now. Not right now. I mean, I've been doing it for 15 years. And I don't intend to stop. As you know, we're buying 100 units a year on average. The target is to get to 1,000. So there's no other strategy that I think that works right now in today's market.
That makes sense. It is to be reminded that it is 1 minute per question, one sentence. One sentence. But it's interesting though, because I think this is the crux of the whole conversation.
Yeah.
And I think for audiences to really understand why it outperforms, you've also got to talk about time.
Yes.
Right. So how much time were you spending managing your HMOs?
Well, actually, my property managers are the ones that are to blame for me repurposing my pro business, because they said, oh my God, the amount of hours. You know, imagine you've got 50 HMOs with 5 people in it. That's 250 tenants, 250 problems, 250 taps that leaks, 250 hairs that goes into the shower tray that gets blocked. You know, as disgusting as it sounds, 250 people that are using your washing machines that then keeps breaking, and then you keep repairing and changing white goods. So imagine for really, probably, to answer your question, around 2.5 full-time heads were going into HMO management alone. And that cost us shed loads of money. let alone the fact that, you can never please everybody when you start to get to that scale of numbers of people. If you've got one HMO, you know what, you're probably doing okay. But to scale anywhere where, when people are coming to coach with me, if they want to scale, HMO is not the right way nowadays.
Yeah, I think that makes a lot of sense. Important point. Next question from social media here is, what are the biggest mistakes or the one biggest mistake a new investor makes?
A new investor makes. Okay, so I think it's the over-optimism sometimes of what they think they can achieve. They always go with, I think I can bridge for 3 months and get out after 3 months, which then the timeline slips away. You just go in and then something happens, planning permission, issues with the lease or whatever it is, it takes a lot longer. So the over-optimism of the invest is a challenge. The second thing that they will tend to do get wrong is, how do the deal stack these blocks of flats? That's the other thing, because you're not buying one house. You're buying a block of 8 flats, 6 flats, 20 flats. There are multiple things that people need to know about it. And if you don't know about it, you might be missing core components of a block. And that's where then they get tripped up at the end.
No, that makes sense. And I think that sort of view on optimism can start to dial up risk. So the next question is about risk. So leasehold reform, opportunity or risk?
So let's just quickly in 30 seconds say what a leasehold reform changes is. So it's basically moving from the current freehold, leasehold, where there's marriage values, where people have to pay significant thousands of pounds to renew their lease, which is punitive to tenants. So this leasehold reform proposal, although not law yet as of May 26, means that they're going to get rid of this marriage value. So when you come to renew your lease on a lease.
Just backtrack on that one, marriage value, because it's all the words after that sort of left my ears, because I was like, do I need to be married?
Yeah. Okay.
It's a real dumb question. But
so let me explain. About? Okay. So I'll give you factual numbers of one of the blocks that even I, after 25 years, missed it, and I've had to pay £27,000 to renew a lease.
I like this. Tell me what went wrong.
Yeah. Okay. So what went wrong is basically I grew too quickly and I missed certain key dates, which is when you look at our latest software proposal to the market now, which you, my friend, will start being a subscriber to soon enough. We will send you the link.
Discount on that straight away. Yeah.
But the idea is, the challenge is when you miss certain dates on your leases. So typically, a lease is given around 99 years to 125 years right now when you buy a new block or an existing block. In my case, this flat in Chadwell Heath in East London dropped below 80 years. And that's the key term. When it drops below 80 years, something called marriage value gets triggered for the freeholder. So the freeholder owns basically the land, and we own the building on that land. So in return, we pay a ground rent. But for us to get an extension on this lease that dropped to below 80 years, we now need to negotiate with the freeholder, and the freeholder is rubbing their hands to say, "Oh, if I renewed it at 81 years and I asked for an extension of 99, so 81 plus 99, that renewal probably would have cost me 6-7 grand to renew that lease. But the minute it dropped below 80 years, and in fact, it got to 69 years by the time I renewed it. This one, I've had to pay £27,000, a significant amount of money. So marriage value is calculated basically saying, look, because it's dropped below 80, we're going to work out what the uplift in value is now on this new flat if I give you the new extended lease, and then we'll half the money. You keep half, me, the leaseholder, and the freeholder gets basically free money. And in effect, this is why people used to buy freehold. You may not remember this, but in the auction 10 years, 15 years ago, people will go and literally bid for freehold, not even buying the building. They just buy the freehold on the building with the hope that these buildings will at some point have a marriage value claim, and they can then make significant thousands of pounds doing pretty much jack shit. So to go back to the question around the leasehold reform, that is going to get phased out with this new plan of the leasehold reform. And that's why it's so important for government to pass it. So is it an opportunity to have leasehold reform coming in? Absolutely, yes, from a tenant leaseholder perspective. Does it matter to us from a title split strategy? Absolutely not, because guess what? When we buy a block, we break the freehold into multiple leasehold. All that's changing is the terms of the lease. So there will be no marriage values. The lease will go from 99 years to 999 years. So 1,000 years. So really gets rid of all of the challenges that a marriage value will have. And the second thing is there's going to be currently since 2023, there's been no ground rent either. So much better for the leaseholder. Much better for, actually, quite frankly, you're making money out of somebody who's actually sitting on a land. It's very medieval, very archaic. So I think that going actually is not a bad thing.
Yeah, I think there's a bigger topic in this, and you touch on it on a number of podcasts in the past as well, around modernizing the system. So, getting to a point where standards are held to something that's more akin to what is normal in the marketplace, more akin to what people experience in their lives, has got to be better for the market in general. Now, there's going to be some losers in that, and they're probably going to be the less scrupulous ones. But in general, I think that these kind of changes are the right things for the market, tenants, the right landlords.
But also, I think, let's talk about, who's losing? So who's losing? Actually, the pension funds. I mean, that's why it's taking so long. So if people don't understand the context of this change, this law is a very simple law. They've already abolished ground rent 23. Why did they not pass the law and go full whack in 23 to say, okay, no more now ground rent, no more now payment on these leases? Why? Because pension funds bought these for years of trickle money. So these money was coming in trickle. So the existing lease that they've got their money on, they've built their financial models on these leases or on these ground rent payments. So any new ones won't have it, but any existing ones, up until they change the leasehold reform, the pension funds still are getting these 50 quid, 75 quid, 100 quid on each of these leases, tens of thousands of leases. That's why successive governments have been stalling on this and letting it phase in. When does it change? Because arguably I could have waited. I've waited 5 years for that to change for this Chadwell Heath flat, thinking if they change it, I won't have to pay this £27,000. But I've run out of time. I've run out of patience. I've paid the £27,000, and maybe the follow-up question is, well, why did I do that?
Why did you do that?
Why did I do that? Well, let me tell you why I did it. So when you have a 69-year lease, you can't get a mortgage, or you'll find it really hard to get a remortgage on a 69-year lease. There are some lenders that if you had one, you were listening to this, you want to come and work with us, we can plug you to our ecosystem of lenders that will lend you up to 50 years. Any lower than that, it's really hard. But anything in that 69-year sphere, you're paying a lot of money. You're paying a lot more interest, and also your loan to value lending will be lower. So instead of getting 75% loan to value, you might get 60% loan to value, 50% loan to value of the value of the flat, the lower value of the flat before the lease is created. So when the lease created, so let's say, for example, at 69 years lease, the value of that flat was 200 grand. After I renewed it now, it'll be worth about £350,000. So there's an element of why did I pay £27,000 to pay for it is to get this increase in value that it's worth market rate at 350. And now I can get 75% of the 350 back out when I need it.
So this place, Chadwell, right?
Chadwell Heath.
Chadwell Heath.
Yes.
Heath is important.
Yes, Heath is important. Chadwell Heath Village maybe one day.
So let's get a scenario here, right? You go to the gym.
Yeah.
And you're taking your supplements.
Yes.
And your omega-3s are doing wonders for your skin.
Yeah.
But you're going to live for 150 years. So let's say you didn't do this on the Chadwell Heath. Chadwell?
Correct. Yeah, Chadwell Heath.
Chadwell Heath.
Yeah.
Not the village. So let's say you live for that period of time.
Yeah.
What happens when that thing gets to zero? So you didn't renew.
Yes.
69.
Very
you're
good
now
question.
sitting on like 1 year, 6 months left or so on that. What happens?
Love the question, because actually in auctions, a lot of flats go for sale when they've got 5 year left, 10 year left, 2 years left. And I see a lot of the central London ones, and I'm always attracted to them, saying, oh my God, there's a Marylebone flat, 3-bedroom flat for £40,000. And people, and I've seen that in my 25 years of investing, people buy these things thinking, oh my God, I'm going to buy something that's worth 500 grand for 40K. Buy it. And then when they buy it, they're like, shit, to renew the lease, it's actually going to cost me £400,000 plus fees. So now you end up thinking, I should have just bought a flat that's 500 grand already.
Do they price it at the market then? Do they go, all right, well, this is what it costs in Marylebone for a 2-bed flat?
Correct.
Right.
So what would happen is, typically to renew this lease, what has happened here, we engage a surveyor. The surveyor goes out and say, oh, hang on, at 69-year lease, it's worth 200 grand. At 170-year lease, because the extension will be given, it's worth 350,000. So the uplift in value is 150,000. So now you and the freeholder can share the £75,000 uplift, for example, and then obviously I don't pay it. I retain that 75, and I pay a proportion, negotiated proportion, with the freeholder.
That makes sense. So you're you're not left in a position where you're like scratching down the back of the sofa trying
looking
to find
for 175,000 pounds.
175 grand.
Or
it's a nice sofa, by the way.
Thank you.
If you're gonna take a bet, you'd probably pick this one.
Exactly. But just to finish off the full answer, if you get to year 0, what happens to that flat? Guess who gets it? The freeholder.
It goes back to the freeholder.
The freeholder swallows it. So now the freeholder gets, in 69 years, the freeholder will get a free flat. That's worth, let's say then, at that time, 700 grand.
And they can redo the lease.
Well, they own the lease. They can then decide whatever, because there's a freeholder, and you've now absolved yourself from that lease. So now the freeholder, basically inherits that lease because nobody else has claimed it.
Cheeky.
And it's run down. Yeah.
All right, let's switch gears on this one then. So same thing, quick fire round.
Yeah.
Renters reform bill. Biggest impact on landlords. Talk to me.
Well, one of the things that we've got, one of the guests that we've got this afternoon is talking fully about renters reform. So I'm going to save that for episode 4 or 5. But just to say to you that the biggest change with renters reform, a bit like the leasehold reform here, is to get rid of this so-called no-fault eviction, Section 21. What is that? Well, up until today, up until May 1st, 2026, somebody can get given a Section 21 notice that says within 2 months, I want my property back. So a tenant has got they don't have the right of tenure for as long as they want, because this Section 21 can be served to them at any one point after a set period of time in the fixed assured short-hold tenancy agreement, which makes it quite the tenant quite vulnerable, in a vulnerable position. Now, the reality of Section 21 is if you're a good tenant, you're a good customer, you're a good buyer, why would the landlord, the business owner kick you out? It's just unreasonable and unfeasible. So renters reform is trying to create a scenario where you give more tenant protection, which I think, quite frankly, if you're a good tenant, you're paying your rent, you have got that protection. We've got hundreds of tenants. We're not looking for people to, when we buy a block of flat with 10, 15 people, the first thing I do is to say to the tenants, look, we want you to stay. This is your home. We want you to stay, but there is a market rate rent that we need to get you. We need to improve the tenant, the property, but we're not kicking you out. The people who get affected by renters reform are the people who are not going to pay, or are not paying their rents, or not looking after the property. And guess what? Actually, there's Section 8 notices that you can then serve. So nothing really has changed for the good landlords. The unscrupulous ones, yes, I think, there is a percentage, like any market, like any in industry, there's going to be a percentage of people who are not very good. Those ones are going to get phased out. And actually, we are seeing that a lot more because people are now panicking with renters reform. So to my view, it's a very big opportunity of buying. Because you see a lot of people, the single landlords, single owner of blocks of flats, not understanding the change or scared. They've been there for 25 years, easy. Now they're thinking, oh my God, I'm being threatened, and Daily Mail does a good job at threatening everybody and scaring everybody. So I think people are exiting the market in droves. And guess what I'm doing? We're getting in droves. We're buying more.
It was my next question, actually. So if you then play this forward, the market is shifting towards larger volume landlords, institutional investors, or those with companies that can navigate the complexity right now.
Correct.
For an individual, let's take hypothetical. A retired GP, worked their entire life. They bought an extra house on the way. This is their retirement plan.
Yeah.
What's happening to Dr. Patel?
So Dr. Patel is in a bit of a predicament. If he's retired and he's got an income with one house, that's not so bad, because let's say the person's actually paid down the debt completely. There's no mortgage on it, making £2,000 a month on average, right? So that's £24,000. Assuming he's got a pension, so that £24,000 goes with the pension and gets taxed at the marginal rate. Let's say 40%, because the assumption you make is the GP saved quite a lot of money as a pension pot. Now, if you have one house, that's not so bad, because you are paying the 40% on that £2,000, but you're retired. The worst people are the ones that are stuck in the middle. So imagine you bought a property in Hackney, for example. You bought a flat that's worth about £400,000, and you were making £300, £400, £1,000 a month residual income. Now, what's happened is your taxation has increased significantly since 2017, because George Osborne, in their wisdom, but it's a guided thing. They want corporations to take over. The Tory party do not want the average person to do well and hoard wealth. So they changed the rules. They changed the rules in 2017, section 20, I can't even remember the section one, but they changed the rules in terms of taxation. So the GP now had to pay you couldn't deduct your interest only part of the payment. So you had to pay the full amount less your marginal rate of 20%. So your taxation went up a lot higher. So whilst the retired person is not so bad because he's not earning as much, but the person who's actually earning a good whack
and has this on the side,
is now paying a heck of a lot more. And that's why you see a lot of younger, meaning middle-aged, 20s, 30s, 40s investors are getting out because they're getting hammered and clobbered by taxation because if they've got it on their personal name.
Yeah. And the reason for the audience, if you can see the video, the reason that Azid was smiling and giving the Hackney example was because that's exactly what happened to me. So bought a property in my name. We then moved out the country.
Yeah.
So that property was there, but the issue came when I was moving back. So getting into PAYE meant that my marginal tax rate was going to be higher than it was when I was out of the country, and therefore the rent being taxed at source. So I can't deduct the cost of the mortgage. It's whatever the rent is, pay your tax, and then whatever's left is it's your problem, mate. If you can't pay this, so I had to exit.
And a lot of people just like you. So you had you bought quite high at a high price because it's a lovely place, lovely area, but you paid quite a premium on it. But more importantly, when you bought it a few years back, we had COVID period level of mortgage rates. We don't have that since Liz Truss. So now you went from say 3.75 to 6-7%, and the cost of these mortgages was so punitive that it made you sell. Because it made no sense, and then you're now using the money to put it into blocks of flats, which is a lot better way of actually redeploying your capital.
And I think there's another. We probably talk about this in the next episode.
Yeah.
But not being wedded to existing investments and being fluid with how you move the cash around has got to be also a mindset that the audience will need to understand and appreciate.
Yeah. And I think that's a great one to say, because I think, dare I say, I learned this bit about not being wedded to an asset too much from you, because I think, I buy never to sell. I've gone on, I've spoken about it for 25 years. I think about it when I go to sleep. But ultimately, the realization that, redeploying some capital that's not performing really well like you did, and now we're now helping you redeploy that money in a much higher rate of return makes sense. And in my case recently, and I know everybody kind of fell off their chair when I said I sold a HMO because I'm redeploying that capital. But let me give you very quick numbers. So I released £100,000 from the sale of that HMO. Before I did that, I was earning £300 net on a 5-room HMO that is costing us so much hassle, cost, and work.
With your property managers.
With the property managers, exactly. So that the sort of rate of return, if you think about it, at the £100,000 stuck into that property, making £300 is $3,600, which is 3.6% return on capital, which is less than what you'll get in a higher interest bank account.
Monzo Max, little plug here, 3.25% if you pay for Max.
But there we go. So I was making probably the same amount, but running a business with 5 people with all the cost in it. Now repatriated the £100,000 to buy a block, which I've already bought one now. That block, 100 grand, will buy me a block of around £400,000. So I would take a mortgage of £300,000. That mortgage, so this block has got 5 tenants in it, 5 flats, producing £30,000. So straight away, when we worked out the numbers, £300 being made on the HMO goes up to about £1,000 to £1,200 using the same capital. And that's why not being wedded to an asset is really important. You need to work out your numbers. If you're thinking about how do I do that, well, look at the deal calculators that we are not able to get you access to online, so you can actually subscribe to it and you can plug your figures in, and it will work out your profitability on some of your HMOs, your title split, but more importantly also your portfolio as a whole as well. So that's been quite a massive change in mindset and redeploying the same capital to make more money somewhere else.
It makes sense. And I think that your business model has evolved over time. So I think you may be doing yourself a discredit there, because you have been moving with the changing environment. It's just, I think my observation as a friend is that you move so quickly to opportunities that your kind of viewpoint, and I think is what you preach very well, and is the reality, is that you want to set it and forget it, right? This is an HMO. It's set up, it's managed, and now I can be a little hands off, which is kind of what you want in terms of passive income.
Yes.
So, but that kind of look in the rearview mirror, I think, meant that you kind of went, okay, well, I can do this in a slightly different way.
Yeah, and I think you're right, because I mean you've seen the trajectory of my company for the last 20 odd years. So we went from 0 HMO to 150 tenant HMO business to now we've just defunct 4 of them that we're undoing very quickly. So to your point, it's about making that decision. Once you make the decision, you've got to action it quite quickly. Don't take 5 years to make a decision, or take 2 years to make a decision and 5 years to execute on it, because that what's the point? Here we're undoing 4 HMOs at the moment, and we're now redeploying that money into blocks of flats, doing the title split, because it just makes more financial sense.
All right, Azid, we are now into the main game, split or pass. You've done this before. Your host has been upgraded for this session. I'm going to give you a deal, split or pass, and then I need you to tell me why. All right, scenario 1, no leases, 6 flats, 250 grand purchase, worth 420K on split, all tenanted. Split or pass?
I'd split it. Yeah, there's no leases created already, so that means it's still on one freehold. The uplift in value is somewhere 260. It's about £160,000 of uplift on a block of 6 flats. I think you say
6 flats.
Yeah, it's 160 grand. It's about 25 grand worth of uplift in each flat. I'd buy it, I'd title split it, pull most of my money back out, and I'll leave 6 flats, increase the rent as I go along on the market rate perspective, and make a passive income on that. I would definitely buy it and split it.
Okay. Rough area. Now we're talking about Chadwell Heath going to Chadwell.
Yeah. Yeah.
8 flats, strong income, but high tenant issues.
Okay. Would I buy it or not? So I have done that. So it's not for the faint-hearted. So, if you're buying a low-value area, so sometimes title split doesn't work. So you need to make sure that if you are buying a block in a low area, that's a low area. It's not going to be a title split. But what I did was I bought it for the income. So I bought a block of flats. I won't name the couple of areas where they are, because it's not very nice to those areas. But they are low-value areas.
Chadwell comment.
Yeah. It's not Chadwell Heath. It's up in Midlands and up north. But I'll give you one example.
Yeah, people going to be not unhappy about that as well.
Yeah. So I paid £250,000. It's now worth £450,000 to £500,000. The income on it is £48,000 a year. So £4,000 a month on a £250,000 worth of investment. That's why I did it. So it just depends on the ability and the investor making sure they understand what they're getting themselves into.
Yeah, and I think with the common thread in a few of these, we'll get on to the next, will be there may be some issues, and is that the place that you kind of invest a bit of time?
Correct. And then, but you need to understand that issue before you jump into it. If you know it's going to be a tenant problem or low value areas, then at least you know that before you get in, and don't just get sucked into the numbers of what you're going to make.
Eyes wide open and just know that it's going to require work. Okay.
Correct.
Third question on the list then, reform risk, not renters reform, but politically reform.
Yeah.
God, this could spiral. 5 flats, good deal today, but leasehold reforms. Oh. It is leasehold reforms.
Hey, it's not the reform party, thankfully.
We should talk about Farage at some point on the next one.
Because I think I could do a whole day on that.
You can see where my head's at on this one while I was jogging down to the podcast. All right. Leasehold reforms.
Yes.
Reform risk, 5 flats, good deal today. Leasehold reforms could affect value, split or pass.
Leasehold reform is not going to affect the value for sure, because leasehold reform is only changing the terminologies of what the lease says. So they're going to get rid of freehold, leasehold, and replace it with freehold and common hold lease. So if you are a bit like you confused about what the hell that is, I'm not going to talk about it right now, but we're going to talk about it in the next episode about the changes of those leasehold reform and what the changes will be. But I will still keep on buying, as I am doing now, 100 units a year, regardless of what these the current lease rules are or the future lease rules will be. Because it doesn't change anything about the title split. We can still activate all the strategies that we're doing right now in the future.
So split.
Buy and split. Definitely.
Buy and split. All right. So messy management, and this is not football.
Yeah.
I think I better read this question. I was wrong on the last one.
Yeah.
7 flats, great location. Great location,
okay.
But poor records and no service charge history. Split or pass?
Okay, that's a tricky one. It's a poor management. When I hear poor management, the first thing I'm thinking of, it's not so much the property pool management, although very important, it's the tenant and the tenancy pool management. So when I'm teaching people on the one-to-one, we're very much diving into the tenancy agreement stuff now because of renters reform coming in. If you buy something where there is no history of the tenancy being managed well, meaning they've been given a deposit protection scheme, the gas certs, and all the legally required stuff, if you buy it, you inherit the problem. You can't say, well, no, that was before my time, before I bought it. The landlord before that did it, or it's not my fault. That doesn't work. It doesn't cut it. So if you're buying a block with history of challenges in the block, from this question around the management, I will be very cautious and I will walk away from things that when I coach, and there's 9 criteria that we look for when we're buying a block of flats, one of which is the tenancy and the management. If it's not there, I will walk away from the block.
So this dips in a little bit back to that renters reform point from earlier. So let's say you were having a rough day, and you decided to split on this one. You didn't pass. You kind of like, oh my God, woke up the next morning. Okay, I now have this thing.
Yeah.
So you've just highlighted a few of the issues that you would need to solve. But if you couldn't solve that, what now happens?
Well, technically, I would work very hard to solve it. So let me give you one example of one of the biggest changes and challenges we will face is that the tenant have got the wrong AST, assured short hold tenancy. They haven't been given the right paperwork by the last landlord, and there's some challenges around the fire regs, and that wasn't done, the safety and stuff like that. So we will work very hard to work with the tenant and the agent, if there's one there, to try and rectify it before we buy it. But if we've already bought it, the challenge is you work really hard to work with the tenant to rectify the challenges. So give them a new AST, or in the future a tenancy agreement. We undo the works around the fire and get the fire risk assessment done. So you try to then really put in place what should have been there beforehand. Now, if it doesn't work, then you've got a bit of a bigger problem. Then, one of your exits is to put it in an auction and sell it. It's not the best way of doing it because you're going to lose money. So it's always the case of making sure you buy the right thing at the right price, or you pass it. And in this case, I would have passed it.
All right. Thanks for the hypothetical. Question 5, heavy refurb, 4 flats, cheap entry, needs a full renovation.
Okay.
Split or pass?
I would definitely buy it if the value is there. So if I'm paying, say, 200 grand, it's going to be worth 600 grand, but I will need to work on 100 grand worth of expenditure on it, and it will take me 3 months, I would still buy it. Now, for my mentees, majority of the time, I would say pass on this one, because we're buying blocks of flats that need light refurb, not full refurb, because most of them are working full-time. They're doing this on the side, light rough building, rather than trying to do this full-time.
All right, Azid. That's the questions answered from the audiences that you broadcast to on a regular. Appreciate the insights. One final comment then from you before we wrap up the intro here.
No, but thank you. I mean, one of the biggest things around social media and getting the questions is live questions that people want to find out and ask. So thank you so much for taking the time to grill me a little bit on this, and also add some of your kind of questions as well, or follow-up questions that people may want to ask, which I think you've done a really good job at asking today.
So I get a discount.
So you get, let's talk about that later. Right, thank you, and I'll see you in the next video.
All right.